You're looking at a job posting for a venture capital analyst position. $60,000 a year, maybe 80 if you're lucky. You click apply anyway because you've heard the stories, the people who fund the next Apple, the next Google, the ones who turn ideas into billion-dollar empires. What you don't know yet is that you're staring at the bottom rung of a ladder most people never climb. Here's what actually happens at each level. Level 1. The analyst. You graduate from a top university with a finance degree or maybe computer science. Your resume is perfect. 3 internships, a 3.8 GPA, leadership positions in 2 clubs you didn't actually care about. You apply to 30 venture capital firms, 29 never respond, one drags you through 3 rounds and offers $65,000. You take it immediately. Your actual job is nothing like you imagined. You're not discovering the next unicorn. You're building financial models in Excel that partners will glance at for 30 seconds. You're reading pitch decks, hundreds of them, sorting through the noise to find the 2 or 3 that might be worth a partner's time. You're researching markets. What's the total addressable market for AI-powered dog food delivery? You'll spend 6 hours finding out. You wake up to Slack messages at 11 p.m. asking for a competitor analysis by morning. You produce it. The average analyst makes between $60,000 and $130,000 depending on the firm. Bonuses range from $15,000 to $90,000. But here's what nobody tells you. There's no carried interest. Carry is the share of profits that venture capitalists actually get rich from. And as an analyst, you get exactly 0. You're on salary, working for people who might make millions if the fund performs well while you get your fixed paycheck. Most analysts leave within 2 years. They go to business school, they join a startup, they move to private equity where the pay is better and the path is clearer. But let's say you stick around. Let's say you prove yourself valuable enough that after 18 months, they promote you. Level 2, the associate. Your salary jumps to somewhere between $120,000 and $170,000. Your bonus potential increases to 20 or even 50% of your base. You're doing better than most of your college friends. You're still not getting rich. The work changes, but not how you expected. You're still not making investment decisions. You can't write a check. You can't commit the firm to anything. What you can do is source deals. You spend your evenings at networking events, startup pitch competitions, demo days. You meet founders. You collect business cards. You send follow-up emails that start with, "Great meeting you last night," to people you talked to for 90 seconds. When you find something promising, you bring it to a principal or partner. If they like it, they take over. You fade into the background. Some associates are just passing through. Others think they're on the path to partner. Most won't find out which they are until years later. The odds of making it are worse than anyone admits. You're watching the principals closely now, studying how they operate, how they talk to founders, how they evaluate deals, how they navigate partner meetings where the real decisions happen behind closed doors you're not invited through. You run due diligence on potential investments. You call references, you build market models, you analyze cap tables and try to figure out if the valuation makes sense. A partner asks you what you think about a Series A opportunity. You give your honest assessment. They nod thoughtfully. Then they do whatever they were going to do anyway. Your opinion matters, but only barely. After 3 years as an associate, you start wondering if you'll ever get promoted. Some firms have clear tracks. Most don't. You ask your principal about your path to the next level. He gives you vague encouragement and no timeline. Then one day, after years of waiting, they make you a principal. Level 3. The principal. Your base salary jumps to somewhere between $180,000 and $250,000. More importantly, you finally get carry. Not much, maybe 0.5% of the fund, but it's something. If the fund performs well over the next 7 to 10 years, you might see real money. This is the moment you realize venture capital is a get-rich-slowly career, not the fast track you imagined. Now you're starting to lead deals. You take point on due diligence. You build relationships with founders that belong to you, not just your boss. You attend board meetings as an observer, sitting in the corner taking notes while partners make the real decisions. You're managing portfolios, checking in with portfolio companies, offering advice that may or may not be taken. You have more autonomy than ever before. You also have more responsibility. When a deal goes south, people remember who championed it. The principal role is where things get complicated. At some firms, this rung barely exists. At others, people get trapped on it for years, waiting for partner seats that may never open. What you're starting to understand is that partnership isn't just about performance. It's about timing, fund life cycle, whether the existing partners even want to share their economics with someone new. You look around and notice something uncomfortable. Most of the principals you know have been principals for 5, 6, 7 years. Some of them will never advance further. They're realizing this job might not be what they thought either. But you're not ready to accept that yet. You push harder, source better deals, build stronger relationships with founders. You're about to discover that getting to partner requires something else entirely. Something most people don't have. Level 4. The general partner. It takes 8 years as a principal. It's 8 years of sourcing deals, building relationships, sitting in board meetings where your voice carries weight but not authority. 8 years of watching partners collect the real rewards while you get crumbs. Then finally, the senior partners call you into a conference room. They're making you a general partner. Your base salary might hit $379,000, possibly more depending on the firm. Some partners at top funds earn $720,000 or even $1 million in base alone. But that's not why anyone becomes a partner. The carry is what matters. Your slice might be 5% of the fund's profits, maybe more if you negotiated well. On a successful fund, that could mean millions. On an exceptional fund, tens of millions. You're an owner now. The firm is structured as a limited partnership, and you're one of the general partners who actually controls the capital. You have check-writing authority. When you tell a founder you're investing, the firm invests. You don't need approval from anyone above you because there is no one above you anymore. This is the moment you realize what all those years were building toward. You attend partner meetings where every voice counts equally. You vote on which companies get funded. You decide strategy, fund direction, what sectors to focus on. You're not just participating in the game anymore. You're setting the rules. But the economics are harsher than they look. The salary is real, but the carry is what matters, and carry only pays if the fund performs. If it doesn't, you can spend a decade looking powerful while building far less wealth than anyone outside the industry imagines. You're also required to commit your own capital. Most institutional LPs expect general partners to invest 1 to 3% of the fund size. On your $150 million fund, that means you're personally putting in somewhere between 1.5 and 4.5 million. You don't have that kind of cash sitting around, so you take out loans against your future carry. You're betting on yourself, on your ability to pick winners on a decade of outcomes you can't fully control. The pressure is different now. When you were an associate, bad deals were someone else's problem. As a principal, they reflected poorly on you but didn't define you. As a partner, every investment decision has your name on it. Every failure is your failure. The limited partners who gave you their money want returns, and if you don't deliver, they won't invest in your next fund. Your career depends on outcomes that won't materialize for years. You start taking board seats. Not observer seats like you had as a principal, but real seats with real responsibility. You're legally obligated to act in the company's best interest. When a founder wants to pivot in a direction you disagree with, you have to decide whether to support them or push back. When layoffs are necessary, you're in the room making those calls. When the company is running out of cash and needs a down round that will destroy everyone's ownership, you're negotiating terms that will hurt people you genuinely like. Half your job is managing portfolio companies. The other half is convincing institutions to trust you with more capital. Pension funds, endowments, sovereign wealth funds. They're not buying your vision. They're buying your track record. And if the last fund underperformed, they can smell it the second you sit down. What nobody tells you is how lonely this becomes. Your old friends from college work normal jobs. They come home at 6, watch their kids grow up. Take vacations where they actually disconnect. You're always on. Always available for founders, for LPs, for the next deal that might be the one that defines your career. Your marriage is strained. Your kids barely know you. The people who understand your life are other venture capitalists, and you're all competing for the same deals. The top firms get the best founders, the best deals, and the best outcomes. Everyone else tells themselves they can compete for what's left. Your firm is respectable, not legendary, which in venture capital usually means you're fighting uphill for mediocre returns. You're making good money now, maybe great money if your carry pays out, but you're realizing this isn't what you thought it would be. The glamour wore off years ago. What's left is the grind, the pressure, the constant knowledge that your professional reputation depends on variables you can't control. Markets shift, technologies change, founders make decisions you can't predict. The best you can do is make educated bets and hope enough of them work out. That's the secret at the top of the venture capital ladder. The people at the top look like they control the future. Most of the time, they're just making bigger bets with better access and praying they're right often enough to stay there. You started as an analyst making $65,000, convinced you'd found the path to wealth and influence. Now you understand the truth. This industry sorts people into those who make it and those who spend a decade realizing they never will. The ladder exists, but most rungs are occupied by people who climbed up and discovered there's nowhere left to go. The analysts reading this right now are imagining themselves as future partners, running billion-dollar funds, sitting on boards of the next generation's defining companies. Most of them are wrong. They'll wash out at associate or plateau at principal, or make partner at a mediocre fund that generates mediocre returns. A handful will break through. They'll have the timing, the network, the performance, and the willingness to sacrifice everything else. They'll reach the top and discover it's not what they expected, but someone always climbs. Someone always believes they're different. Right now, a 23-year-old is updating their resume, preparing to apply to that analyst role, dreaming of the life you just read about. They have no idea what they're actually signing up for, just like you didn't.